Thanks for joining us for today's webinar, Valuation and Tax Considerations when Buying and Selling a Business. My name is David Blain. I'm a partner and director of the firm's Entrepreneurial Accounting Solutions Group. And joining me today also is Eric Blocher, who is a partner and director of our business valuation services, and Jeremy Peachey, who is a partner in our tax services group. Guys, why don't you just say hello?
Hello.
All right. All right. If you're not familiar with us, McKonly Asbury is an accounting and business advisory firm with offices in Camp Hill, Lancaster, and Philadelphia, in Bloomsburg, Pennsylvania. We offer a wide range of services and organizations in various industries. For more information, please visit our website. If you've joined us on past webinars, welcome back. If you haven't, our monthly webinars feature various business topics to keep you updated on what's going around in the business community. To be sure to check us out on our website to catch past presentations as well as current information through our blog. Our thought leadership subscription, M&A Insights, has been revised to give our subscribers the opportunity to select which topics are most relevant to them. So subscribe today and stay informed. Right there's your little code there. Take a picture of that. You can subscribe today to a number of our different industry groups. All right. Now, we're going to go to the agenda for today. So today's agenda, exciting stuff. We're going to be talking about some tax considerations and just valuation considerations when you're buying and selling your business. We're going to talk a little bit about working capital, deal terms, some other things on the tax side. So we're going to highlight the importance of targeted working capital and how to determine it and the impact of seasonality. We're going to also analyze the impact of price versus terms and how that impacts the sale, gain on understanding of the tax implications of an asset sale versus a stock sale, and analyze the implications of an installment sale versus a cash sale. So my colleagues here are going to be leading the charge on this. I'll jump in with a couple of comments and questions as well, but we're looking forward to doing this. But let's talk about what's really important. Let's go to the next slide there. Let's talk about polling questions. So I want everybody to note, before we go to polling questions, that if you have any questions for polling questions, remember that to get your CPEs today, you have to keep in mind that there will be 4 polling questions and you have to answer all 4. So you got to pay attention. The polling questions could just pop up. Who knows? It could be at any time. Just be ready for the polling questions to make sure that you answer all 4 in order to get your CPE certificates. And if you can answer all your CPEs, we will get those certificates out to you in a week or so. But keep in mind, no late responses are going to be accepted, so make sure you're paying attention to your polling questions. So first one is up. Do you wish to receive CPE for attending today's webinar? Answer yes or no. Let me throw this one out to Eric and Jeremy. Are you looking for CPE?
I'm always looking for CPE, Dave.
That's right. That's right. I'm pretty sure anybody who is a CPA on this call that is in a new reporting period is going to want CPE, because you'll probably get one CPE of probably specialized knowledge or something like that, I would assume. So, all right, 78% are attending for CPE. So make sure you've paid attention and you answer all 4. You've answered the first one. You're doing well. You got 3 to go. All
Dave,
right.
I'd like to think that they want the knowledge too and the CPE.
That's exactly. Well, he doesn't want the knowledge coming from guys like Eric Blocher and Jeremy Peachey. Seriously, come on. All right, Eric, I'm going to turn it over to you to talk a little bit about working capital in a transaction.
Okay, thanks, Dave. Yeah, working capital in transaction, in my opinion, is and can be one of the most contested items in a transaction negotiation. Now, we all know from Accounting 101 the definition, or the traditional definition of working capital. Yeah, and that starts with, current assets minus current liabilities. Whatever's in that bucket, you include, and the difference between the two is your working capital. And that takes you back to Accounting 101. But for transaction purposes, we really need a new definition, because that doesn't, cut muster when you're looking at buying and selling a business. So the new definition, working capital, needs to be done, because most transactions are done on a cash-free and debt-free basis. And because of this, the traditional definition of working capital just won't work. So for transaction purposes, they developed a new definition. It's called net working capital, and it starts with the same basis where current assets and current liabilities, but it removes cash because most transactions are done on a net of cash basis. It removes non-operating assets and liabilities, and those are assets and liabilities that might be on your balance sheet, but they really don't have anything to do with operations. Some of them might be like, if you have current cash value of life insurance or a non-operating loan, things like that, that would be removed. That doesn't really deal with the net working capital that a buyer is going to be looking at. So it removes that. It removes, like I said, non-operating liabilities. It removes debt. So the current portion of any debt maturities you would have would need to be removed. And then it also removes other debt-like liabilities. One thing to note, though, is the income tax liability. If it's been accrued in your corporation, you have that sitting on the books, that is a non-operating liability. So that is typically removed as well for getting to the net working capital. So that's a little bit about the definitions, and you'll start to see, and we'll go through some examples a little bit later showing, what it looks like. But that's the new definition that you should be working under whenever you're looking at a transaction. Next slide. Okay, now I want to introduce a new term called the net working capital peg. Now, I do not know why it came up as peg. I tried to do the research and look for it, and every other definition in the world for what PEG could stand for came up. But in my mind, it's a negotiated target, working capital, that's put in either into a sales agreement, the final sales agreement, or it might be mentioned in a letter of intent. But it's like a pin almost. It's a peg you want to hang something on. It's a number of working capital that you're going to be shooting for come the end of the transaction, and it's negotiated. I bring that up because the buyer and the seller don't always see eye to eye on it. In most cases, they don't see eye to eye. They're always negotiating and arguing for higher or lower net working capital peg. What's the impact of that? Well, if the net working capital comes in now at the end of the transaction, because typically transactions start during the middle of a year or middle of a period. It's not always at the end of the period, and your working capital may be different than what it is at the end of the year. So they negotiate what they think the peg should be, and then when the transaction happens, you look at what was the final net working capital, and then if the net working capital comes in higher than the peg, then that would be a dollar for dollar increase in the transaction price. And if it comes in lower, it's a dollar for dollar decrease in the transaction price. So given this impact, a buyer would want to have a higher peg. That means they're getting more assets, and they would have to have more working capital transferred to their business when they buy it. And a seller would want to have a lower peg. So because of that, that's why it's often negotiated. And many discussions and a lot of time can be spent determining what that amount is. We can also have something called a collar, the net working capital collar. And in many transactions, not all of them, but in many of them, there's a collar established, which is typically a percentage up or down over the working capital peg number, so that if the final transaction, at the final transaction date, if the net working capital comes in within that collar, either 95%, 105%, or they could do it 90% to 110%. If it falls within that range, then no adjustments would be made. So that's another thing that you frequently can see during transactions. So if that happens, then the purchase price wouldn't need to be adjusted at all. Okay, next slide. Net working capital due diligence. It's extremely important to review and analyze net working capital because there could be adjustments for many different things. It's typically not just the number that's the end of the year. Seasonality is a big issue, and we'll go through an example that highlights some of that. But net working capital could be adjusted to account for seasonality issues, and many businesses operate on seasonality. They may have built up assets at the end of the year when they're really light on working capital during the year, or vice versa. You could have it where you have higher working capital during the beginning, first and second quarter versus the third and the fourth. And if you just look at it in a point in time, it doesn't really give you the picture that you need to see to make sure that you have enough working capital, to operate the business after transaction.
And Eric, on that seasonality thing, I mean, a couple good examples of that could be construction companies, right? Depending on, if maybe you're a excavation company typically don't do a lot of work in the wintertime. You might do, that you might see more buildup of your business in the spring and summer. Lawn and garden centers might be something too that you can see, right? I mean, there's not a lot of activity January and February, and probably low inventory. So you got seasonality adjustments there for just as examples of industries. Yeah,
retailers might build up, a lot of inventory at year end for Christmas season too. So you don't really know, if they didn't sell it all, it still could be high. But yeah, their seasonality can really come into play. Another thing to look for is non-recurring or non-operating accruals and payables. What that do with those, it may understate your net working capital, or need to be made an adjustment need to be made in an interim period if they're not typically done at year end. And an example would be like accrued bonuses. If the company typically makes accrued bonuses at year end, like a big amount, like accrual for the whole year, that might not show up if you're doing the transaction analysis prior to that. But that's a liability that might show up at year end. So you got to factor that in and account for that. Prepaid expenses sometimes aren't recorded or adjusted quarterly or just at year end too. So you really need to go back and look at what is in each of the accounts and see when the adjustments were made. Because if you actually close on the business during the interim period, you want to make sure that you don't have a liability for something that you didn't account for in the net working capital. Accounts receivable without an appropriate reserve, or inventory without a reasonable reserve for obsolete inventory, that could overstate the net working capital. And that's part of the due diligence when you're looking through things. To see accounts receivable, you would want to get an aging of it. And, if you just have the number, okay, it's all accounts receivable, and count that in working capital, but then you look at, half of it is over 180 days old, you really might want to question that, and you not want to have that included because you might not receive it.
Eric, Eric, to just build on that a little bit more too, when we do quality of earnings work, or we do some, we'll call it agreed upon procedures, due diligence type of work, accounts receivable clearly comes into play if, from the perspective of aging, and you really want to take a really deep, hard look at that aging, because that ultimately impacts your cash flow, right? Which is ultimately going to impact your working capital. Same thing on the inventory side. A lot of organizations don't really do active inventory observations, or maybe have perpetual systems in place, and they just try to estimate what they think the inventory value is. So, not having a reasonable reserve for what you think is obsolete, or removing the obsolete inventory can have a pretty significant impact to your working capital.
Yes, it can. This is all part of the due diligence, and quality of earnings review kind of goes hand in hand with a lot of the stuff that we're talking about today. It's just making sure you really have a handle on the numbers before you go and finalize a transaction. Part of your due diligence. If the company traditionally doesn't collect their accounts receivable in a timely manner or up to industry standards, that should factor into, I guess, the value of the company. Because if you're buying it, you'd want to pay less for it to some degree. If you're not going to be able to get cash, it'll take a while for the customers to get used to having to pay on time. So all of those things are factors that you'd want to look into when you're doing your working capital due diligence, and account for it during the transaction process. Next slide. Non-operating accounts payable for capital expenditures. In particular, I've had discussions where someone wanted to include an accounts payable in the working capital for capital expenditures, and my argument was that it was not a typical working capital item. It is working capital is a capital expenditure that is outside of that. Related party payables, which are not operating in nature, can understate net working capital too. They're, if companies have related ownership, a lot of times they'll have due to and due from related party entities, and they may have nothing to do with the operations of the business, but it looks like a liability because they got some cash from another entity. Those, you have to account for too. So you really need to do a deep dive and look for adjustments that you might need to make to your working capital. Deferred revenue and customer deposits is another hot topic. These should be reviewed and addressed in the agreement in depth, because what happens here is they represent cash that's received by the company with an obligation to provide, the services in the future. Potentially the new owner, by the new owner potentially, but the cash has already been received from the seller. And in a typical transaction, when it's net of cash, here you have a liability factored in there, and the cash that you don't have the cash to provide the services. So you really should look at deferred revenue and customer deposits and see what they're for and account for them when you're looking at and trying to determine working capital.
Yeah, Eric, just to kind of to expand on that a little bit more, that as you said is a really hot area or hot topic. We've seen that on multiple due diligence projects or quality of earnings projects where there's deferred revenue that's related to contracts, and the seller thinks that, well, because I'm taking the cash from the business, that I'm going to take the cash that's related. I'm going to just take the cash, and they don't think there should be an adjustment related to deferred revenue, and there really should be, because at the end of the day, it's that's exactly what it is. It's a balance sheet item. It's not a P&L cash flow item. It's a balance sheet item, and it needs to be reserved on the balance sheet. And that always turns into a sticking point at some point in time, especially if there's large amounts of deferred revenue.
Yeah, I mean, one of the issues that's not listed here is the basis of accounting. Because if you have a company that's historically reported on the cash basis, you may have a lot more work ahead of you to try to figure out, what receivables, what payables, and take it to accrual so you can get a better picture of what the working capital is. Yeah,
that's a great point, Eric.
Yes, like I said, some other adjustments you may need to look at. Like earlier, I said prepaid expenses is one of them. That sometimes they only account for prepaid expenses at year end. They only accrue for bonuses or things like that at year end. And if you're doing your negotiations during the interim period, you want to look at that and see, because you want to account for the portion of it that should be tied to the previous owner's performance, and you shouldn't be having the buyer shouldn't be having a liability for that, only for the portion for which they're they would have the benefit for the earnings stream. Next slide, please. Okay, so what we're going to do is we're going to go through a working capital analysis. I like webinars where you actually have some numbers, you can get your hands dirty by digging into them. So what we're trying to do here is to go through some examples, and these are just examples that have been simplified to some degree, because as you can get from the last couple minutes, the factors that can complicate a working capital analysis are many, but we wanted to look at something that's a little simpler. So what we have here is we have 3 years of working capital, and this right now is at traditional working capital, and it's at year end. So this is would be at December 31st of 2023, 2024, and 2025. We do have monthly revenue numbers for each of the years, but the amounts here are the annual revenues and the annual profits. You'll see later when we start looking at things monthly where it's broken out. But we start with the traditional working capital, which includes cash, accounts receivable, inventory, prepaid expenses. We've removed most of the items that you would need to adjust ahead of time just to simplify it. Then the liabilities are accounts payable and accrued expenses. So you take the difference between the two, and you have traditional working capital of 1.6 million in 23, 1.96 million in 24, and then 2.3 million in 2025. And you'll see those numbers come up. So that's just stating what the traditional look of working capital is. So the next slide. Okay, so here's where the analysis starts coming into play. My argument is that you shouldn't take working capital, and we do this for evaluation purposes too. And this is an example of analysis we might use for evaluation, but you don't want to look at just 1 year point in time for seeing what's normalized. I would recommend that you look over an extended period. You also have to factor in growth and if there are any unusual circumstances with the business, so you'd have to dig deeper. But for here, what we're seeing is we have 3 years of revenue, 3 years of the current assets less the current liabilities. So we have the unadjusted working capital for each of the 3 years. And in this analysis, they're taking the average of the 3 years. So we have the total revenue from the 3 years and the total unadjusted working capital for the 3 years. Divide those two, and you get a 3-year average working capital as a percentage of revenue of 49.41%. So then what you would do is you would take that percentage and multiply that by the revenue at the end of 25 to see what the estimated required working capital would be at year end for 2025. And that calculation is here. And so you see that the estimated required working capital would be 1.96 million. The actual working capital is 2.3 million, and so there's an excess working capital of 3.46 million. Now, that's valuation related, but if you think about the collar, example is, this is at year end. Say if the transaction was done or leading up to it was begun in June or July and they closed at year end, this might be the actual calculation to see what the difference is. And if this is outside the collar, if the 346,000 is outside of the collar, then the difference would have to be added to the transaction price. So that's the working capital analysis at year end from a traditional standpoint. Okay, next slide. Now here we have the net working capital analysis at year end. That's the updated definition where you can see we start with the same numbers with revenue for each of the 3 years, the current assets for each of the 3 years, current liabilities, to have the unadjusted working capital, and then we take out cash. Cash is the only adjusting item that we mentioned earlier that was here. We didn't have long-term debt. We didn't have non-operating assets. We didn't have accrued taxes or any other debt-like structures. So we only take cash out of it. And then we come down to an adjusted working capital, which is the adjusted net working capital. We take the total of the 3 years revenue times the total of the adjusted net working capital, and we come up with a new percentage of 6.19%. So we would look at the estimated required net working capital by doing the same calculation, the 2025 revenue times the 6.19% to come up with $246,000 of required net working capital. And then we would look at the difference between the two, and this is much closer, where they would be under by $331. My assumption is that this would be, certainly within a collar if it was established, but you get to look at the difference between the traditional working capital percentage and the net working capital percentage, and it's big, just because the company had a lot of cash. They were sitting on a lot of cash, and that's going to go back to the benefit of the owner, the current owner. When they sell, they would have all this cash. Okay, next slide, please. Okay, so now we're going to look at seasonality. What you'll see here on these slides is you'll see the December numbers tied in the exact amount that we showed previously for both the traditional and the net working capital analysis. But I like doing it. I think Dave would recommend whenever you're doing it, you really should be looking at a monthly analysis. It'll show you seasonality. And here we have 3 years. So we're going to use all 3 of the years and develop some ratios and look at some new percentages, you'll see. But for each month, what we've done through is we looked at each monthly revenue, the profit from it. Then we have the cash balance at each month, the accounts receivable, inventory, prepaid, accounts payable, accrued expenses, and then the traditional working capital amount. And then we took out cash to show the net working capital amount. And at December 23rd, you can see the net working capital for each month. You can see at the end that 6.12% is the same ending net working capital from the previous analysis. But this one we aren't looking at net working capital here each month because we don't have historical data. You'll see on the next slide what we begin doing. Next slide. Okay, here we move on to 24. It's the same numbers, the same analysis, but what we can start to do is we can have the trailing 12-month revenue numbers here. So the January 24th shows the trailing 12-month revenues for that period because we have the previous year. And then we can start to see the net working capital percentage for each month as it goes on. And what you'll see is that it starts around the same as the year end, but then come May, June, July, and August, they have a significant buildup of net working capital because they require more of it for the summer. And what in fact this is based on is we modeled out what a landscaping company might be. So Dave, you picked a good example there for highlighting that, because during the summer and their busy times, they're going to need a lot more working capital than they would otherwise. I would argue that they probably build it up during the summer period and burn through it then during the slower periods, in particular November, December. And that's something I think you would want to know if you're buying the business. So let's move on to 2025. and the next year's monthly analysis. Okay, so here we go through the final part of it, the final analysis, where we look at the third year. And with the same month-by-month activity as in the previous 2 years, but now the trailing 12-month revenue is basically trailing 12 months, including 2024, going forward. And you'll see the same type of buildup, where in May, June, July, and August, the working capital percentages are at least doubled from the rest of the year. So what we come down to at the bottom of this, you'll see the sum of the total 2024 and 2025 trailing 12-month revenue for each month. We added all those green highlighted cells up, and then we took the sum of the total 2024 and 2025 net working capital for each month, and we took the average of that. The total sum net working capital of 8.5 million was divided by the 94.57 million, and we come up with a working capital percentage of 9.08% on average for each month. And yeah, I think it's better to calculate it based on number totals than trying to get an average of the percentages. An average of percentages is not the same as an average of all the numbers totaled up. So that's how we would do it. And then we would look at the 2025 total revenue of 3.9 million times the new percentage, or the seasonality adjusted working capital percentage of 9.08, to come up with a calculated required net working capital of $362,000 roughly, which is a different example than either year ends we're looking at, because it didn't factor in the seasonality. And this analysis can become much more complex when you start having to adjust monthlies. During the middle of the year, they might have had a lawsuit or something like that, where there was a liability for a non-recurring item in there. And that's part of the due diligence, where you would want to adjust that out because it's not going to be non-recurring, and it would impact your the monthly net working capital calculation for that month. But that's just one adjustment. There could be other multiple adjustments in here for significant non-recurring events. You could have had a fire, a casualty, something like that that could throw a month off, and you would need to make adjustments and normalize those things. So
Eric, on this analysis, if you're a business that's seasonal in nature, this is a great analysis to really kind of keep up to date and because it really kind of gives you a good idea of what that what we'll call it, adjusted, normalized, what that adjusted, normalized type of working capital might look like, knowing that you have seasonality in those numbers.
Yep, I agree.
Okay.
I think you can get yourself into trouble when you just look at year end. And then I would also argue that when there is seasonality, I'd want to look at it over a longer period instead of just 1 year, because things can happen during 1 year that may not happen, in the past or expect to happen in the future. So I think a longer period needs to be factored in. At least it's my personal opinion. Okay. Next slide. So the overall impact, in examples, if you look at the traditional working capital, a 3-year average working capital as a percentage of sales was 1.9 million. And, that's from just a pure accounting perspective, or valuation maybe, but from a transaction, cash isn't going to transfer. So you really should be looking at the net working capital calculation. So the net working capital calculation without seasonality factored in was, 3-year average. It comes out to $246,000 roughly would be the estimate for the PEG. And then if you do factor in seasonality, that's a 2-year average total trailing 12-month net working capital as a percentage of trailing 12-month sales revenue. You come up with a working capital of 3.6, or 361,000, which is higher than that. So you would want to have that. It's about a 5% difference in a transaction that might come in with this profitability might come in around $3 million. You'll see some example before, but it's a 5% difference in the working capital PEG, which when you're trying to make as much money as you can, or in a deal, it can come into play. And I think it's always important to to get what's realistic.
Okay.
Next.
I think next item is, are we on to the next polling question, I believe? Yes. Here we go. Polling question number 2 for everybody. So everybody making sure we're paying attention here to the polling questions. What is your favorite Winter Olympics event to watch? Hockey, figure skating, or curling? I'm going to go to Jeremy. Jeremy, what's your favorite?
Well, I mean, the fact that the U.S. men's and women's team won the gold this past year, that was pretty exciting. And that men's game, if you watched it, I was kind of on pins and needles. But I kind of like curling. I'm going to throw a curveball.
Yeah, you know what?
The way they push those stones, it's pretty incredible.
Yeah, you know what? It's not one of those things you're going to watch throughout every year, right? But during the Olympics, curling does kind of like it kind of like is kind of fascinating in some aspects, right? Although I got to say, I'm a hockey guy. I love hockey, and both the men's and women's finals were pretty fantastic. So.
Dave, I agree with you there, but to me, curling is the Bob Ross joy of painting of the Olympic events. You watch it, and all of a sudden you're just like, oh, you're chilling out. You know, if I'm having problems getting to sleep or anything like that, curling, I love it, but it would knock me out. It's fascinating, but it is so relaxing and peaceful.
Right. Well, we got our answers here. The majority, 45%, came with ice hockey, then figure skating. You know, we didn't give enough credit to the United States women's gold medalist there in the individual free skating. So pretty good. And then curling, 13%. So, all right, we're already halfway through at 2:31. So let's move on to the second item. We're going to talk about price versus terms. I'll turn it back over to you, Eric.
Okay. There's a classic negotiating strategy in valuation and across other transactions. It says you name the price and I'll name the terms. And this takes me back to an actual example when my mom made this wonderful chocolate and peanut butter icing cake that my brother and I both wanted, and we couldn't decide, you know, who would eat it. And she said, okay, you know, I wanted the big piece. She said, no, Eric, you're going to cut it, and then your brother's going to pick the piece. I didn't like that at all because I couldn't weasel out an extra little sliver for me because he could then pick. But this comes into play. You know, you name the price and I'll name the terms. It can both make sense. You know, that's the point here. In a transaction setting, terms can mean an awful lot. In particular, financing terms can impact the ability of a deal to cash flow. You know, what we'll do is we'll have an example where we'll look at a traditional, or maybe not traditional, but a normal transaction price with how much is financed, how much is down paid, and normalized debt terms. Compare that with something with different terms. So to give some background for this, let's assume that the business has an EBITDA, which is an earnings before interest, taxes, depreciation, and amortization of $600,000, and that's a proxy for cash flow. We're going to assume no growth, no capital expenditure requirements, and no working capital requirements. And those are just simplifying assumptions to show the impact that terms can have. The weighted average cost of the capital is 20%, and it has a tax rate of 25%. So that's just some background information. And using this information, I'll take you into the next slide, which will show some analysis. Okay, so this is the first deal A, which is the standard or more normalized terms. You'll see $600,000 with a cap rate of 20% gets us to a value of the business of $3 million. And in this transaction, the down payment with cash out of hand is 40%, and the loan is 60%. And you can see the down payment and the loan amount. The loan term is 5 years, and the interest rate is 8%. So what we did here is we showed total income prior to interest expense, the actual interest expense that would be paid on a $1.8 million loan over 5 years at 8% for each year. That comes down to net income. We take off the 25% for income taxes. That's the projected net income. And then we start looking at the cash that's available to service the debt. So we add back interest expense and come down to the cash available to the shareholders and the creditors. From that amount, we retake out the interest expense and the principal payments. And you can see the principal payments over the 5 years equal to $1.8 million. That gets us to the cash after debt service that's available to be paid to the owners. And highlight again the EBITDA. And the next slide takes the analysis down a little further, where we look at some bank ratios, where we're targeting senior debt and total debt service of those ranges. You can see that the debt service is above the ratios with cash flow. And then you see a quick calculation for a leveraged buyout. If you hold on to this investment for 10 years and you had cash out of pocket for $1.2 million, and because there's no growth projected, you would sell it in 10 years for the $3 million because you're not growing. We're assuming tax rates don't change and the cap rate don't change. So at the end of 2035, you would sell it for $3 million. The internal rate of return on your cash flows is 19%, which do the calculation, it should approximate your discount rate, and it does. So the deal works from a cash flow perspective, and those terms make sense. So let's go to the next slide where we're going to have some different terms. Okay, and I've seen this in place where the seller was willing to take out a seller note for almost the whole amount. And so the down payment is 10%. The loan is 90%. They also offered extended terms to payment terms of 10 years. And the interest rate on the loan was the current applicable federal rate for a long-term loan with monthly payments, which at December was 4.46. But the flip side of that is the purchase price was higher. The purchase price was $750,000 higher, which is, I think 20%. No, do the math. It's significantly higher because of the terms. So he was getting more money back for it. So let's go through the same analysis. Over the 10-year period, interest expense were taken off each month. That is based on the 4.46% and 10-year loan. Come down net income, calculate the income taxes, projected net income. Then to get to the cash available to shareholders and creditors, we add back interest. We subtract off the interest expense payments and the principal payments, and you'll see that it does cash flow, positive cash flow after the debt service. And let's go to the next page where we can look at what the implications are of that. They actually have higher and better coverage ratios because the debt service payments are smaller because it extended out over a longer period and interest rate was lower. So let's go down and look at the calculation of the internal rate of return. Because even though you paid more for it in this instance, it was only because of the specialized and extended, the interest rate, the payment terms were better, and the term was longer. But if you sold it at a market level, you would sell it for $3 million again, because the terms that you had are not the same terms that would be available to someone on the market. So we look at, you paid $375,000, which is the 10% down, and this was your benefit, and you got $3 million for the sale at the end of 10 years. Your internal rate of return of the cash flows is all the way up to 31%. So because of the special terms, the buyer made out better, and the seller could get more. And in this situation, it was because the seller wanted to pass it along to the current owners, or the current buyer was someone who worked for the company. So he was trying to reward something. So he accepted, a longer period, but he ended up getting paid a little bit more. So the next slide is because a higher than market level financing was available. The financing terms were longer, lower interest rate was offered, and higher price could be paid. Debt service cover ratios were met in the second deal with a higher price at a higher internal rate of return. But however, they're not market level assumptions for a reason. They're not always available. And then the next and the type of sale might be one of the most important terms. And Jeremy's going to go into that. So we didn't do an example of implications of that yet, but that's another important term which Jeremy will touch base on next.
Okay. All right. On to polling question number 3. Make sure we're paying attention. You got to have all the polling questions. Here we go. What is your favorite drink on a snowy evening? So, Eric, what do you like to go with? I think, Eric, you're an adult beverage guy.
Oh, Yeah, I am. I'm going to have a tasty bourbon probably, but close behind that is something my dad introduced me to when I was a child: hot chocolate with buttered toast dipping in it. Oh, it's really good. I didn't believe it until I tried it. It's something you have to try. Hot chocolate with hot buttered toast dipping in it is wonderful, but I can't get past the adult beverage to help warm me up.
Yeah, Jeremy, what do you think about that?
I'm stuck on hot buttered toast, David. I don't know.
Yeah, so am I. I'm totally confused.
Yeah,
I might have to try that tonight, though, Eric.
You take hot chocolate and just have hot buttered toast, dip it in. I was a non-believer until I tried it, and then I went through like half a loaf of bread and 2 things of hot chocolate when I was a kid.
All right, let's get the answers. We are neck and neck between adult beverage and hot chocolate. Oh, and then coffee's 25%. Yeah, I snowy day, coffee, but the hot chocolate, I'm probably a hot chocolate guy. Is probably where I want to go with that answer. So, all right, so we got 3 polling questions done. So I hope everybody has stayed up to their polling questions. So we're going to move on to Jeremy's going to talk about income tax considerations when we look at deal structure and we look at transactions. So Jeremy, I'm going to turn it over to you.
Thanks, David. Yeah, so as Eric outlined, there's a lot of considerations from cash flow and interest rates and also tax rates in his analysis of price versus term. So we want to consider, how do we look at that tax rate? How do we lower it, so that we can put more cash in our pockets? And there's a lot of things we need to think about ahead of time, even before we, start thinking about whether we're selling our company or even buying a company. Like, what are the things we want to look at, both from a seller and a buyer? One of the most important things to look at is, how are we structured? How are we legally structured? I have some options there, whether it's a sole owner, an LLC, S Corp, C Corp. This matters significantly because, as we'll see in a slide or two, depending on the structure of our sale, we can potentially have different types of tax answers based on our legal structure, and then also based on the type of sale we sign up for, whether we're selling or buying. So, for example, one of the hot things out there that we're talking about a lot with clients is if you're a C corporation and you've been in business for a while, and maybe you started this business from scratch 10 years ago, there's this interesting little code section called 1202. And if you sell the stock of a C corporation and you qualify, there's a lot of qualifications. Don't miss that part. But you could potentially sell stock in a C corporation and not pay any tax. All of a sudden, that internal rate of return that Eric was talking about looks really good. So, there are very, very important considerations when we're selling a business or buying a business, depending on how it's structured. Another thing that there's a lot of buyers right now that are in their letters of intent for someone selling a business, they may ask that they restructure or reorganize their legal entities. So if you own an S corporation and you're selling it, you may have buyers out there that are asking you to reorganize into, an LLC, or restructure your business with holding companies and things like that, because the buyer wants to take advantage of other tax advantages and how those asset deals are structured that we'll talk about in a bit. So the business structure is a very important starting point in how we address a buy or sell, whether we're the buyer or the seller. Another thing to look at really is our balance sheet. What does our balance sheet look like? And Eric addressed a lot of these topics with his working capital analysis and the different types of working capital. But then, we have to keep in mind, if we have debt on our balance sheet, that debt has to be paid back. And, that basically, reduces the proceeds we may receive. So we may have less cash than we otherwise would if we have a lot of debt on our balance sheet. We could potentially structure a deal where some of that debt goes with the buyer, say we're financing assets, financing equipment or something like that. And maybe we can structure the deal so that debt that's financing equipment goes along with the assets. So that's less debt we have to pay off and then more cash in our pockets. So it's important to understand the types of debt we have. Can we pay off debt, or is there a way to refinance debt in better terms or things like that before we sell the business? Tax basis and versus book basis. This comes down to assets, really. What are the starting points of how we calculate gain? We may have GAAP financial statements, and we may have a balance sheet that has all types of assets on it, whether it's equipment, whether it's accounts receivable or inventory and things like that. And then there's liabilities as well that will reduce that net working capital that Eric talked about. But the tax basis of those things matters when we're talking about what is our tax that we're going to have to pay on this gain. And if we're looking at our financial statement balance sheet, we're going to have a very different answer than what the tax basis of those assets are. For the simplest example that I can give everyone is, let's say we bought a piece of equipment for $1 million in 2025. And for our financial statement purposes, we're depreciating that equipment at 20% a year. So we have, a net basis in that asset of $800,000, which is our $1 million less $200,000 of depreciation. But because we have bonus depreciation, we wrote that entire cost off on our tax return in 2025. So now our tax basis in that piece of equipment is zero. So if we, just sell that piece of equipment, we have $1 million gain for tax purposes, but we only have, say, a $200,000 gain for book purposes. So this matters. And, that's a very simple asset that we can look at, but this impacts all types of assets, whether it's accounts receivable, it could be inventory, it could be, the deferred revenue that Eric talked about. There are very many assets and liabilities that have a different tax basis than our financial statement basis. So this is very important to understand. And then finally, assets, we may have non-business assets on our balance sheet. Maybe we have some assets that a buyer would not want to bring along in the sale, or maybe we have some personal assets or quasi-personal assets that we want to keep, that we don't want to sell. So we really have to understand what is on our balance sheet, what are we going to sell, what are we not going to sell. Next slide. So finally, deal structure. Like, how do we account for the sale? There are two main types of sales: an asset sale versus a stock sale. And as you can imagine, a buyer-seller scenario, one party likes one type better, and then the other party likes the other type better. And this is where the negotiation comes in. And this is part of the letter of intent, or LOI. Before you sign that LOI, you should understand what are the implications of either type of this sale. And going back to the slide or two before, what is my structure of my business? Does that impact my structure of the sale of the deal? Yes, it does. So we have to look at what are the impacts to both the buyer and seller for these different types of transactions. A buyer prefers an asset deal because they get to step up the basis of the assets to fair market value. They have limited exposure to any tag-along liabilities or unknown liabilities, skeletons in the closet, so to speak. And then if they have goodwill with the transaction, then they can amortize that over 15 years. So this is an asset deal buyers really, really prefer, because they have the ability to amortize and get that tax deduction for any excess that they purchase for the assets. If a seller is in an asset deal, most likely they're going to recognize ordinary income, and ordinary income tax rates are much higher than capital tax rates. You're going to have to recapture depreciation on those assets that you have had on hand and have depreciated, which is a higher rate yet as over capital gains rates. So, sellers don't really like asset deals, but sometimes that's where you can negotiate maybe a higher price, so you can end up with a higher net cash after taxes. So this comes into the negotiation of the overall selling price. A stock deal, this is so the seller really they're selling the stock or the ownership of the company. Sellers love this because they say, well, this is all capital gain, and I can treat it this way. It's a very simple transaction from the seller's standpoint. They can kind of collect their cash and walk away. there's an opportunity to treat it as an installment sale. So maybe the seller and buyer can agree that the proceeds will be paid over a 3 or 4 year time horizon. So the seller won't have to recognize the tax on that sale until the year they receive the cash. So the seller likes this type of deal. From the buyer, though, a stock deal isn't always the best option because they're basically taking over the company as is. They're stepping in the shoes, so to speak. There might be liabilities that they don't necessarily want to be responsible for. Back to my skeleton of the closet, there's unknown items that they, maybe the seller doesn't even know. Maybe there's judgments or other potential legal liabilities out there. And most of all, the buyer doesn't really like a stock deal because there's no tax deductible goodwill. And again, there might be goodwill from a financial statement purpose, but from tax purposes, there is no tax goodwill. And this is really why a buyer does not like the stock deal. Now, I should say there are special tax code sections where we can treat a deal as both asset and stock deals. These are very specific fact patterns and specific items for mainly S corporations, but it's definitely something we can look at and talk about. And it's something that, as a business owner, you should know is out there so that it's part of your negotiation strategy. Okay, next slide.
Yeah, so I would assume you're talking about like 338H10, the elections.
Correct.
Yeah,
Correct.
Exactly. That is something that is pretty common. You see that on a number of different deals, depending on the industry, the type of deal. Specifically, if it's like a service industry, you might see 338H10 type of deals.
Correct. Yeah. But there's a specific fact pattern for those. They just don't qualify for all deals, so it's just another special tax consideration that's out there. So as we continue on the deal structure, the most important thing is obviously the buyer and seller have to agree on what type of transaction are we going to do. Are we going to do the asset transaction? Or are we going to do the stock sale transaction? Obviously, they have to agree, and that's where the negotiation comes in. Most likely before the letter of intent's signed. If I the seller, sell you the assets, buyer, because that's what you prefer, then I might require a higher price. If I can sell the stock, I might be willing to go a little bit lower because I know my taxes will be lower, and I know that maybe I can defer some of that tax over time. The other thing just to consider, so there's something called hot assets, which really only comes along when you have a partnership or an LLC as taxed as a partnership. Hot assets basically treat certain assets as ordinary, and these primarily are accounts receivable and inventory, and that's just a code section within the tax law where, because those are kind of normal operating assets in the business, collecting money from customers and selling inventory to customers, those are treated as ordinary, so we can't get capital gain treatment for those assets. So it's something to keep in mind. And then, I touched on tax basis on your balance sheet, but then there's also, more importantly, what is your individual basis in the company? You own this company. Do you know what your individual basis is in this company? And this can sometimes be a very big pitfall for certain individuals because they may not know what their basis is, and they may have to go back in time and reconstruct it. Or maybe they gifted some of the ownership to their spouse or to a child, or maybe they did some estate planning and they moved some of the ownership into a trust. And was the basis, was it tracked with that gift properly? That could have a huge impact on the overall gain of the calculation. So I think there is really a lot of due diligence that needs to be on place with the seller, particularly of your actual basis or ownership in the company.
Yeah, Jeremy, just to kind of just elaborate on it a little bit more too. I think I see that a lot, specifically where some owners know their basis pretty well, you know what I mean, and they keep track of that. But there's a lot of owners that don't, and if you should, as an owner, you should try to make sure you keep track of your basis in the company. That's something you can ask your tax professional to do at the end of the year when your tax return is done. That way it can help you just kind of keep track of the growth in your basis, where that stands, and how, how that can impact a transition of your business or a transitioning stock in your business.
Yeah, that's absolutely correct, David. It's good to know what that is from year to year. Next slide. Okay, just really quick on a couple other topics here. How do I minimize taxes and maximize cash? So we talked about some of those things. The biggest thing here to take away is, any type of estate planning you may do. We can set up different trusts and different ownerships so we get the gains outside of our estate. Keep in mind, estate tax is a separate tax from income tax. So it's good if you have a very successful business and you might be able to sell it for more than the state tax exemption, which for an individual is just over 15 million today. It's something you want to think about as you get ready to sell a business. Can I restructure into trusts and a different ownership to alleviate future estate tax considerations? Am I filing state tax nexus? Am I filing in all the appropriate states? Income tax, sales tax, property tax, all of these items. Because this could have an impact on the buyer if they are doing their due diligence and they realize, you're operating in 3 states where you're not filing. They may ask to put up some additional indemnity escrows or other liability escrows that reduce your overall purchase price. So you want to make sure that you understand where you're filing and that you're filing in all the appropriate jurisdictions. Okay, next slide.
Just real quick on that state tax nexus too. I mean, that really is kind of important now more than ever. I mean, I recall assisting with a deal about 2 years ago where they had nexus issues in multiple states and they didn't realize that, and it ended up impacting the purchase price because of the amount of work that had to be done to try to figure out what the liabilities were in those states, specifically around payroll taxes, because they had employees in those states and also some sales tax.
Yeah, those state tax nexus can really, and usually those are things that are looked at, kind of in the 11th hour of the deal sometimes, because, the buyer and seller, they're working out the working capital, they're working through the contracts or the assets, and then, they're kind of ticking through their checklist and they realize state taxes. And so that can really add a wrinkle, we'll say, at the end of a deal sometimes, David. So I agree.
Yeah, I think it's important then, if you're looking to sell, that you really need to do a lot of internal due diligence to prepare yourself to be ready to be sold. And ideally, you would have handling all these issues prior to getting an LOI, and it wouldn't come into play.
Yeah, that's right. So just really quickly, just other things to consider as we're getting ourselves ready. Do I have all the appropriate team in place? Like, do I have, a team of attorneys, of my banking team, my accounting and tax accounting folks? These are the folks that are going to help you with the process, understanding, the areas of your business that you need to focus on and tighten up, or also how to calculate, the net working capital and getting the most value for your business. Really simply, are all my organizational documents in order? If we did gift shares of the company to another individual, did we document that properly? Do we have the stock certificates or the membership interest certificates corrected? Do we have all those original items? That's going to be important when you go to the table to sell. Again, how can the transaction be financed? Eric touched on it briefly in one of his examples. You could have seller financing, that may help with cash flow. It may help you from yourself as a seller. It may help the buyer with being able to cash flow the deal. And then can we do the installment sale? I touched on that. Can we defer taxes if we're selling certain stock and pay the taxes in a future date? And then also kind of, do I have a management team? Are they staying on with the buyer? Do we need to provide incentives for them to stay? Would keeping the management team in place help the buyer be successful and ultimately help us garner a higher selling price? So these are all considerations that are kind of not necessarily tax, but they do come into play when we're looking at the overall structure of the deal and the things we have to have in order as we want to sell.
Okay. I think we are ready to move to the final polling question since we are right up on 3 o'clock here. So, you know, what is your take on shoveling snow, sidewalks, driveways, etc.? Do you love it? Is it good exercise? Do you hate it? Pay a neighbor's kid, or is it okay? Just need to talk to whoever plows it and shuts and shut after that. So while everybody's trying to answer those that last polling question, since we're at 3, I'm just going to say thank you for joining us today's webinar. If you have any further questions regarding today's presentation, feel free to reach out. Our team will be happy to assist. A recording of today's presentation will be posted on our website and social media sites in a few days. And for those of you who are requesting CPE and answered all the polling questions, those tickets will be sent out within the next month. We have we do have an upcoming webinar on March 26th. My neighbor here in the office here in Camp Hill will be doing a webinar on cybersecurity maturity model certification, CMMC, and are you ready? And where our C3PAOs, I love that, C3PAO, authorized CMMC team will provide insight into what a C3PAO is looking for when conducting a CMMC level 2 assessment. And they'll have a special guest with R2D2 on that as well. So, all right. Anyways, final polling question. It looks like it was the last one. It's okay. I just need to talk to whoever plows it. So I will say again, if you we got the March 26th, the webinar coming up. You can register now at that link, or you can come to our website and you can see where that is. You can register there. So again, as we you can flip through the rest of those slides there and just get down to there's our contact information for myself and Eric and Jeremy. Eric and Jeremy, great job on the slides and going through the deal structures and the analysis on working capital and tax considerations. So without any further ado, I'm going to just say thanks to everybody for joining us today and enjoy the rest of your day.